let's get started. So welcome to today's session, which is titled Net Zero Strategies from Commitment to Accountability in the Real Economy. My name is Carmen Nuzzo. I'm professor in practice and the executive director of the TPI Global Climate Transition Center here at the LSE, or TPI Center for short. The center, for those of you who are not familiar with our work, assesses companies, banks, and sovereigns in the progress that they're making towards the low carbon transition. We are the academic partner of TPI, the Transition Pathway Initiative, which is a global asset owner-led initiative supported by asset managers with over 155 investors in its networks. So today's session actually focuses on the center's newest research area, the net zero strategies, which is based on frameworks that evaluate whether companies' transition plans and decarbonization strategies are robust and concrete and not just aspirational. And it's also an event which is part of the London Climate Action Week. So thanks for being with us, because I know there are lots of competing sessions going on at this time as well. So when the TPI started now nearly 10 years ago, very few companies published transition plans. And the focus was very much on target setting and whether these companies were setting targets that were compatible with the Paris goal agreement and also ambitious enough. And it was in that context that when the TPI was launched, we began to develop decarbonization benchmarks for hard-to-abate sectors, which remains the focus of the center, to assess the degree of companies' net zero target alignments with Paris goals. So fast forward to today, we now assess through our carbon performance workstream 580 companies in 13 hard-to-abate sectors. These are the largest companies in the world, but also the largest by carbon emissions. And with our management quality framework, which assesses the strength of corporate climate governance, we assess 2,000 companies in 60 sectors together with our data partner, the LSEG, the London Stock Exchange Group, in their data and analytics department. So net zero strategies now builds on both dimensions of the transition that we've been assessing so far. And it doesn't just ask what companies are doing in terms of ambitions, but how they plan to get there. So in other words, what we're trying to address is, are these commitments robust enough? Are they credible? And how are they translating into real action? And for now, this is a new work stream. So we're focusing only on oil and gas and diversified mining companies, two very important sectors for the transition. Subject to funding, we may assess more companies. So if you know of anyone who might help us, send them our way. We really would like to keep all our work as much as possible as a public good as it's been so far. So the plan for the session is the following. I think I have to show you this slide, this is the right one. So first of all, I will hand over very shortly the floor to my colleague, Sayed Alireza Modirzadeh, or Modir, as he likes to be called for short. He is a policy fellow at the LSE and the research project lead for net zero strategies. He will present the results of the report that we published earlier this month, focusing on oil and gas companies and diversified mining. And then there will be a panel discussions. Our esteemed panelists are already well placed. There will be a discussion with Vanessa Hava-Williams, who's a member of the UK Transition Finance Council and chair of the UK Finance Market Review that was convened by the HM Treasury. In the middle, there is Kate McGrath, who's head of ESG fixed income at Aberdeen Asset Management. And then last but not least, Peter Metcalfe, who's the executive committee member of IPECA. IPECA stands for International Petroleum Industry Environmental Conservation Association. Bit of a mouthful, but Peter will tell us a bit more about the association as he gets his chance to speak. Before I hand over to Modir, I have some quick housekeeping rules to give you. Please ensure that your phones are put on silent. We welcome your remarks on social media to raise awareness about what we do, but stay with us as well. This session is really for you. Note that today's session is recorded. If technology doesn't fail us, and there will be colleagues of ours taking pictures. So if you have any concern about that, do let us know. We'll have a room for questions at the end of the panel, so start thinking about those. Also, for those who are following us online, please use the Q&A function that you'd see at the bottom of your Zoom meeting screen. And finally, if there is a fire alarm, it's for real, so please evacuate the room and follow the instructions of my colleagues. So before I hand over to Mudir, I would like to thank Kay Patalano for her help to putting this event together. She does quite a lot of work behind the scenes, and that often gets unnoted. And also the authors of the report, which include, in addition to Mudir, Ella Davies, Megan Fitzpatrick, Maxime Sinclair, Valentin Yan, and Professor Simon Dietz, who's the research director of the center. All the work of the center is really the fruit of collaborative and team efforts. So I'm really proud to be leading them in this endeavor. You can find all our resources on our website, transitionpathwayinitiative.org. So without further ado, please, Mudir, the floor is yours. Thank you.
Despite recent backlashes, and what a glorious start to the presentation, more and more companies have committed to reduce their greenhouse gas emissions. Our data on management quality of 2,000 companies, as Carmen mentioned, in more than 60 sectors show that around 80% of these companies have set targets to reduce their emissions. On the other hand, the quality or ambition of these targets have increased over time. Our assessment of 600 companies for their carbon performance shows that nearly 45% of companies' long-term emissions reduction targets are now aligned with the goals of Paris Agreement. This 45% used to be less than 20% 5 years ago. But now the question is, are these commitments real? Or in more sophisticated terms, have these commitments been translated into real economy changes, or have they remained symbolic? Or how can we distinguish empty commitments from the plans with actual implementation plans? Well, in order to answer this question, we have to open the black box of company decision-making that's called transition plans. What is a transition plan? Well, let's ask Vanessa. The Transition Plans Task Force has defined a transition plan, an outline of the company's strategy that lays out its targets, actions, and resource allocation towards or to transition towards a low-carbon economy. In other words, a net zero target shows where the company wants to go, and a transition plan explains how it intends to get there. Jurisdictions, standard setters, and regulators are increasingly expecting companies to publish their transition plans. A testimony of that is that the ISSB disclosure standards have been adopted in 37 jurisdictions that cover 40% of market capitalization. Investors, as Kate will explain for us, use transition plans to evaluate the company's decarbonization strategy in terms of its credibility, investability, to identify the key external dependencies and risks and opportunities associated with these plans. Companies, as Peter is here with us, also use this opportunity to communicate their decarbonization strategies and to build investor confidence in the fact that their commitments have been backed up with the actions and resources that it needs. But what does a good transition plan look like? Well, if you're asking me, I would say it's a waterfall chart or waterfall-like that depicts the roadmap from the company's current emissions to its targeted emissions level, with quantified contribution of different decarbonization levers, with timelines for implementation, with resource allocation. But the answer to the question of what a good transition plan looks like needs to be addressed and answered separately for each sector, because different sectors have different emission sources, different challenges in terms of the technological shifts and the readiness levels of different technologies and policy dependencies that different sectors face. As Carmen mentioned, we have developed net zero strategies assessment frameworks for the oil and gas and diversified mining sectors that we cover different aspects of the company's decarbonization strategy, from operational emissions, methane emissions, to different business segments of the company in relation to transition, such as upstream oil and gas, or climate solutions, for example, in the oil and gas sector or in the diversified mining sector, the different products that matter more or most for the transition to a low carbon economy, such as thermal and metallurgical coal, iron ore, bauxite, and key transition materials, and other different emission decarbonization strategies that we assess in these sectors. These frameworks have been developed in consultation with our colleagues and friends from the Institutional Investors Groups on Climate Change, or IGCC, from whom I have learned a lot. This year, we assessed 22 companies across these two sectors, major oil and gas companies, big diversified miners. And the assessments were based on the publications that were disclosed before January 2026. So some recent changes might have been occurred, as some of you might know. But these companies cover around $3 trillion of market capitalization, and we have a good representation from different regions of the world. As you can see, we have, for example, BP, Eni, Equinor from Europe. We have Chevron, ConocoPhillips, Exxon from North America. We have Petrobras from Latin America, Santos, Woodside Energy from Australia, and we have some miners from different parts of the world, as you can see in this graph. So let us see the results of our assessments. First, let's take a look at the results for the oil and gas sector. This graph shows the scores that the companies have achieved in different areas. So each blue or dark blue dot shows the average score of the company in that specific area that we are showing, and the green bars show the average score of the companies in that area. And as you can see, the areas of methane and operational emissions rank 1 and 3. And the areas such as upstream and midstream and downstream that consider the company's disclosure on how it is planning to evolve its core oil and gas business with the low carbon transition score the lowest. The disclosures on the area of climate solutions are relatively advanced. But what this graph does not show is the scale of the plans. This graph does not show if companies are planning to wind down their fossil fuel exposure or increase and diversify into low carbon alternatives. And for that, we need to explore more and zoom in to some of these areas. So I'm going to explain the areas of methane, upstream, and climate solutions tonight. Well, methane abatement is urgent. If we want to stop global warming to only 1.5 degrees more than the pre-industrial levels, the IEA urges a 75% reduction in 5 years. The good thing about it is that methane abatement is economical, it is low cost. The bad thing is that the trend in the past, in recent years, is showing a slight upwards looking trend in the upstream oil and gas methane. To address this problem and issue, a lot of international initiatives have been created, such as global methane pledge that was signed in COP26, oil and gas methane partnership that encourages high quality reporting and monitoring and measuring methane emissions, and zero routine flaring by 2030 initiative by the World Bank. And as we can see, most of our companies have committed to all these things, have committed to achieve the gold standards of OGMP or to reduce their methane emissions and have set targets. However, companies have rarely specified the actions, the timelines, the technologies that they are intending to use to reduce these emissions. So the question is the question of how they are planning to achieve the targets remains unanswered. In the area of upstream, we assess the company's oil and gas production plans. We assess their capital expenditure on oil and gas. We see if they have committed to not to invest in new oil and gas fields or decommissioning the existing oil and gas fields. There are two disclosure gaps that I have to mention before reading the tables. One is, what we see is that companies disclose production plans only stop at 2030. So companies are not telling us how they're gonna achieve their net zero target by 2050 without telling us what is the share of oil and gas production in that portfolio of production. The second gap is that only 5 companies on the left-hand side disclose oil and gas production plans separately. And as you know, these are 2 different fossil fuels with different roles in decarbonization. But what does the numbers tell us? The numbers say that OMV and Shell are switching from oil to gas, so they're decreasing their oil production and planning to increase their gas production. BP and maybe Repsol are maintaining their current upstream levels, and all other companies are planning to increase their oil and gas. In aggregate, these plans imply a 14% increase in oil and gas production by 2030 compared to now. And we can compare this 14% increase not with low carbon scenarios that project a decrease in oil and gas production, but even they exceed the demand of oil and gas in a business as usual scenario that is projected by the International Energy Agency is going to be 6%. So this is a question that we need to ask ourselves and our panelists. What does this mean? Why do oil and gas companies want to increase their oil and gas production faster than demand? Are they planning to compete with low carbon alternatives by keeping the prices low? Maybe. But does it necessarily mean, if we are assessing one specific company, does it necessarily mean that these plans are bad because they're increasing their oil and gas? Not necessarily, because of 2 reasons. Firstly, maybe the company is planning to increase its low carbon energy production even faster than its oil and gas production. That's my argument in the next slide. But when we are assessing each company's, so the second argument is that when we are assessing each company, we need to see the historical performance of the company as well, because the low carbon scenarios are based on a cumulative emissions that end up in a certain temperature goal. When we consider that, we see that 3 of our oil and gas companies with separated oil and gas production figures are aligned by 2030 with Paris Agreement goals, namely OMV, Shell, and Eni. And one company, OMV, despite its increased plan by 2030, is still aligned with a below 2-degree scenario. That's OMV. And that might be explained with the decrease that has happened in the previous years, that might be explained by the exit of its Russian assets. In the area of climate solutions, we assess companies' targets to diversify into various low carbon alternatives, such as renewables, low carbon fuels or biofuels, for example, production of other climate solutions, EV charging stations, provision of CCUS to third parties. And these 9 companies have provided such disclosures and disclosed such targets in a quantified way. And what we see is that European companies are pursuing a broader range of climate solutions compared to, for example, North American companies that only disclose targets for low carbon fuels. But what do these targets mean at scale? Are companies planning a fundamental shift from oil and gas production to low carbon business models. When we calculate the planned share of low carbon energy production in the company's energy production, we only reach a number of 5% at maximum. And that tells us, together with the fact that no company is planning a wind down of oil and gas production, and the diversifications are not looking like a fundamental shift to a company's business model, are suggesting that the credibility of the emission intensity reduction targets of the companies might be under a serious question. When we look at the company's CapEx, capital expenditure plans, we see a weak performance in terms of the disclosure of investment planning, even in the core oil and gas business. The three top rows show the core oil and gas businesses, and the three on the left-hand side. The three below bars show the CapEx disclosures on low carbon alternatives. So not a lot of companies are disclosing such plans, but can we compare companies' capital expenditure and ask what company is expending more on, for example, low carbon alternatives? The answer is it's not that easy, because companies do not disclose their capital expenditure in the same way. So they follow certain boundaries. Some companies disclose organic capex, some companies disclose inorganic capex that includes acquisitions, for example. And not all taxonomies prescribe a certain way of disclosing capex, but when we compare the EU taxonomy aligned capex of the companies that have disclosed under EU taxonomy, we can say that Repsol has spent around 40% of its capital expenditure in the year of 2024 on low carbon or EU taxonomy aligned products, followed by OMV, Total, Equinor, and Shell. Let's go very quickly to the sector of diversified mining. We assess 6 companies, as you can see, and it is a diversified mining sector, so the companies have diversified portfolios of products. Coal production matters because of its emissions at the use phase. Iron ore and bauxite matters because of the emissions at the processing phase during the steel making or aluminium smelting, and the assessment of key transition materials, the minerals that facilitate the technologies that support the low carbon transition, also matters for us. As you can see, companies have different portfolios, but all of the companies do produce at least 1 KTM. The results show that, and in here we cannot compare company scores because different companies are assessed in different areas because of their portfolios. But at least we can say in what areas companies are scoring better, and that is the iron ore. So we have BHP and Rio Tinto, if I'm not mistaken, that have disclosed targets and strategies, and have disclosed projects and partnerships with customers that they are selling their iron ore to in order to reduce these downstream emissions. If we take a look at the operational emissions at the top, again, comparatively to the oil and gas sector, companies are almost moderately scoring well. And the disclosures emphasize on operational emissions again. And if we take a look at the worst performing area of just transition, we see that companies show a weak performance. All 6 companies have committed to reduce their greenhouse gas emissions and to transition in line with the principles of just transition. However, companies have rarely translated these commitments into formal policies specific to the mining sector. For example, mine closure and environmental rehabilitation, mine certification, and the rights of indigenous peoples. 2 more slides and I'm done. The KTM area. So only 2 companies out of 6 companies have disclosed plans to increase the production of key transition materials. However, other KTMs actually are more needed they grow faster with the 1.5 degree scenarios. And as you can see, among the two companies that we assessed, Vale's targeted increase of the production of copper is aligned with the 1.5 degree scenario. So it supports that increase in production. My takeaways would be, and I'm trying to pave the way for the discussion with our esteemed panelists. So targets are widespread. The disclosure of transition plans, not so much. And three takeaways for the discussion would be the disclosures emphasize more on methane and operational emissions than on transforming their existing core business models with the low carbon transition. Secondly, the low carbon energy production plans are limited at scale. So are the plans to scale up the production of heat transition materials. And thirdly, capital allocation disclosures remain one of the weakest areas despite its importance in transition planning. You can use this QR code to access our report, and thank you so much.
Thank you, Modir. That was really excellent and very clear. And I think it really shows that the transition planning stage is easier said than done, and it brings to light the difficulties that companies have in disclosing the elements of the transition, but also in getting to the target, and they may choose different paths and not always the same. So we, as a university, are not normative in that respect. We assess what companies disclose, but there is this tension between, shutting down versus diversifying and restructuring the business models to be more sustainable over the long term. So I want to turn quickly to the panel for some very quick reactions. I haven't done justice to all your CVs, so I would ask Peter, Kate, and Vanessa, when you give your quick reactions to the report, in addition to the takeaways that Modir has highlighted, what stood out to you, what you think is problematic, even in the analysis perhaps that we've conducted so far. And as you do that, if you can tell us a little bit more about your role and your day job, that would be great. We're fortunate to have a company representative, an investor representative, and also Vanessa wears the hat of the market-driven policymaker initiative. So we really want to encourage the dialogue among these three stakeholders to bring the transition further. Peter, perhaps I can start with you, since we've put oil and gas on the spot.
No problem. Thanks, Carmen, and thanks, Modir, for your work. My main reflection is congratulations on the report, actually, and it's really good. I think any evidence-based analysis to bring that sort of consideration into this debate is really helpful. So congratulations. It made me. Oh, sorry, I should introduce myself. So it's Peter Metcalf. I'm here representing an organisation called IPECA. Well done for spelling it out in full. I don't think I can repeat that. IPECA is essentially the Oil and Gas Industry Association for Environmental and Social Performance in the Energy Transition. It was set up just over 50 years ago now at the request of the UN Environment Programme. It's a non-lobby organisation, so it doesn't advocate with governments for particular policies. What it does is it shares knowledge and technical standards between its member companies on environmental and social issues. So that's what it's for. My day job, I work for a company called Woodside Energy, which is an Australian headquartered, primarily liquefied natural gas producer. And I'm on IPECA's executive committee, which is why I got the job to come here tonight. If I could get on board, so I've had probably one observation and then two comments which stem from it. The main observation was, you made me think about the energy transition, Modir, when I read it, because it feels to me like we're both making progress and falling further behind at the same time. And what I mean by that is renewables are growing faster than ever. Costs are coming down. We can all see those cost curves. And so you look at that data set and you think, wow, we're making great progress. And then you look at the fact that fossil fuels continue to grow. Coal in particular continues to grow. The reason for those two things is that as much as renewables are growing quickly, total energy demand is growing quicker still. So we're actually still in a phase that some people call the energy addition, where the renewables are growing quickly, layering on top of the existing energy system rather than replacing it. Obviously, as renewables continue to accelerate, then there'll be a tipping point at some point where that will start to change. why is energy growing so quickly? And there's all sorts of reasons, but actually I think it's important in this sort of conversation that we recognize that it's not necessarily a bad thing at all. And when you look at through the Sustainable Development Goals, firstly, one of them is about energy. SDG 7 is about access to energy, which is by no means universal in the world yet. But when you look at a lot of the other Sustainable Development Goals as well, tackling hunger, ending poverty, decent work, economic growth, clean water and sanitation, they all really depend on having access to reliable energy supplies. So that's why energy goes up, which then gives me my two observations, just to finish up. One of them is, I think, and this goes to your analysis, Modir, I think in this occasion, this isn't a chicken and an egg. We do know which one comes first in this case between the new lower carbon energy and the old higher carbon energy. We have to build the new before we get off the old, because we need to have the energy, because the energy fundamentally is not the bad thing, it's the emissions. And so that trade and why that's happening is a really important thing to keep in mind. I'll come back to some of that later. And then the second observation I had, so that's the world we see. Even if we think of the world we might want to see, in which that switch is happening more quickly. And maybe everyone in the room probably has in their head their own figure of how quickly you'd like to see coal, oil and gas decline. So I'm not here to debate that. IPCC 6th assessment report said in 1.5 degree pathways, median gas down 45% by 2050, oil down 60% by 2050. That does not mean that every oil and gas company gets equally 60% or 45% smaller. It means that the least efficient 45% of gas companies cease to exist. The most efficient 55% of gas companies are still there, doing absolutely fine. In fact, probably the sector consolidates and the really good ones get bigger. So they would in a system that is doing what your analysis wants to do, you would see examples of companies appearing to swim in the opposite direction for that reason.
I guess you're looking at each other to figure out who's going to be.
We want to win. Yeah, that's right.
Going to make
that's
the
right.
cut.
Yeah.
Kate, turning to you, what stood out as a quick reaction to the report?
Thank you. So I'll just introduce myself. Can I just check you can all hear me loud and clear? Excellent. Thank you. So my name is Kate McGrath, and I am the head of ESG, that's environmental social governance for fixed income at Aberdeen Investments. Now, for those of you who haven't heard of Aberdeen Investments, and by the way, this is an English accent, not an Aberdonian one, we have around 380 billion assets, and of that, around 150 billion are within fixed income. And of that 150 billion, around a third of that has got an ESG label or mandate or some type of ESG criteria. So that might be low carbon, it might be transition, it might be excluding oil and gas, it might be excluding coal. So a variety of different criteria we have there. So my reaction to this paper is I'm quite angry. The ambition that I have been told about as an investor, I've been told about net zero targets from oil and gas companies and other energy producers and also miners. But we're lacking credibility. And that's what this paper really, really brings to the fore. It's not new to me, but when you spend your life looking through sustainability reports, and then you see these statistics where you see that actually in 2030, we're only going to have 5% low carbon energy from these producers. That is not the message that I'm getting from their sustainability reports. Am I calling out these companies for greenwashing? Potentially. However, when we're thinking around oil and gas, and we can see here that actually the majority are increasing their production, fundamentally that is misaligned with the International Energy Agency's net zero pathway, which is quite explicit in that no new oil and gas fields are required. And yes, I do agree there is a place for oil and gas in the energy transition, and you have to look regionally as well. So, for example, we know that in the energy mix for the US, we'll certainly see these fossil fuels for a lot longer. However, I'm running climate transition funds. My target is to get to net zero, and my target is also to not greenwash my clients. So I'm angry looking at this. And as I said, I spend a lot of my life looking at these companies and seeing who is genuinely transitioning. And it's not new for me, this. And I can go into more detail later about the way that we invest and what specific KPIs and pieces of information we're looking for. But fundamentally, it's that green CapEx. And we can see from this report, it's just not happening fast enough.
Maybe before I go to Vanessa, if I can ask as a follow-up question, you said you're angry, and thanks for the candor. But there are also different types of investors. You're part of the ESG team, so obviously
Exactly.
you look for that type of disclosure, and that type you really scrutinize these reports. But there might be other colleagues of yours within Aberdeen or other organizations that actually don't reward companies who are going through the painful exercise of having upfront costs for that transition that will yield less going forward, and demand is there. So the temptation to just grab the quick win might be there. I'm not justifying
No, absolutely. And I think
companies, but I'm
this
saying
is
that there is an element of that. In February, we hosted a similar event here, and one of our PhD students showed how, based on the research that he did on the engagement that investors have been doing with Climate Action 100 plus companies that are the largest producers in the world, sometimes the companies do get conflicting messages from the ESG teams on the one hand who say, you're not doing this fast enough, versus the portfolio managers, if the two functions are not integrated, saying, actually, don't do it too fast because this is affecting my P&L.
Yeah, exactly. But for myself as an ESG investor, when I'm looking at sustainability reports, which are written for people like myself, I would believe, and you're seeing a variety of case studies and the amount of times that they probably mention green or sustainable or transition, and you see all that qualitative information compared to this quantitative piece of research, there's a clear mismatch, and it's really hard. I mean, for companies, there's greenwashing, there's green hushing. I mean, lesser of two evils, and you have US investors who you probably can't even mention these terminologies to, and then you have someone like myself who's involved in climate transition. But essentially, as a climate transition investor, I want to keep my seat at the table. I want to stay invested in these type of companies, because then we don't get that divergence where you have investors who don't per se care about ESG sustainability holding the dirty browner companies, and then you have green investors piling into greener companies. So I want to keep my seat at the table, but this shows me the difference between the qualitative information I've been given and the quantitative facts.
Great. Thank you. Vanessa, over to you. What stood out to you?
So I'm going to say some things that are sector specific and some things that.
Sorry, do you want to say a little bit about the UK
sure.
transition fund?
So my work in transition started with the Transition Plan Task Force, where I chaired the oil and gas sector guidance project, which published in April 24, I think, something around about then. And then I chaired the Transition Finance Market Review for the government, which was to look at how do you make the UK a hub for credible transition finance. And now I'm sitting in the Transition Finance Council, which was one of the recommendations of the review. It's all a bit incestuous, which was a
common thread.
That there is a thread, yes, which is the home for reporting how we're getting on in actually performing the recommendations. So that's me. By background, a lawyer, but not a finance person. So I think the oil, gas and coal, those sectors are fundamentally different from a lot of the high emitting sectors that have a transition pathway that doesn't involve completely reimagining your business. I mean, from ground zero. So I just think the challenge in those spaces is bigger. We've been through two fossil fuel shocks in the last 5 years, where the price has gone up. It is a brave company to be walking back from a strategy that gives them, significant profit over a period. If that is not, if their investors are telling them to, not to change. And I suspect that there will be issues that sit both at the investor level and in terms of the company's own structure and culture and ethos. So I think that is just properly difficult, and it is actually a bit different for the diversified miners, for whom there is, in relation to transition materials, clear areas of opportunity that are a bit more aligned to what they were already doing than going into low carbon. solutions. I recognise that there is a crossover because the e-fuels are more proximate and you're using refining technology and skills, but even so. So that's the specific points. The general points around COP26, which was a different world geopolitically, but around COP26, there pretty much wasn't an organisation that didn't come out with a net zero target or ambition. And whether they had actually thought exactly how they were going to get there, I'm feeling not everyone will have had a cunning plan at that point. And you know, we are now in the implementation phase where it's getting more challenging. And then the other thing I'd say is everyone starts with operational emissions. Scope 3 is genuinely harder. It's particularly hard in some of these in some of these sectors, but it's just hard for everyone. So we need to just moderate some of the expectation, I think. And there are opportunities, which I think you identified. You know, if we could get real traction on methane, that would be amazing because of its immediate impact.
Great. So you mentioned, Vanessa, the operational emissions as a quick win, so to speak, or low-hanging fruit. So, and we've heard Kate being angry. So maybe I turn back to Peter saying, you know, you've had targets for quite a long time. Woodside, we're not talking about Woodside in particular, but even the oil and gas sectors, actually, they do have targets on our management quality framework. They score really highly. They've got good governance processes in place. But then when it comes to the implementations, these are the results. So what would you say are the main barriers that prevent you from going faster from target setting to the actual transition implementation and from disclosing some of the information that we would like to see?
I think one of the great things about the report is it draws this distinction between operational decarbonisation and the products that you're making, and I think that is a really important thing to hold in your mind. And so it's what are we making, and is that sustainable? And then how are we making it, and is that sustainable? And the operational emissions, I think people are making more progress on those. There's more to be done, clearly. Why is the transition difficult on that first one, though? Because that's really I think the main thesis there. I think there's a couple of things, and it really boils down to profitable demand, because we're companies. So if you look at some sections of the lower carbon market, like renewable energy, there's clearly demand for electricity today. So if you can build and deploy renewables and get them into the grid, you'll get paid for them. You just need to make sure your costs are lower than the price. So some companies have done that, and many of them are not with an oil and gas company background. They're just actually specialist companies and are probably going to be better with it than us. That's fine. Some oil and gas companies have decided to do it. Typically, they're the sorts of oil and gas companies that you probably have got household names because you know them because you've been buying petrol from them at their service station. So they've got a customer relationship that they can try and turn into we've been sending you petrol to charge your car. Now can you come into our forecourt and charge you with electricity? That's available to them. Company like mine, we don't have a direct relationship with end consumers. We're essentially a top of the value chain, and we sell to wholesalers like utilities. So very difficult for us. We've got no particular skill set. Our skill set's in molecules. We handle gas at very low temperatures, and we're good at subsurface geology. So that says to us, okay, well, if we can do that, if we can do LNG, liquefied natural gas, at minus 161, I think it is, degrees Celsius, maybe we can do hydrogen. So let's have a look at the hydrogen economy, and maybe we can do carbon capture and storage. What we found on both of those is the demand has emerged much more slowly than we'd hoped when we started to set our targets.
So let's ask who's going to buy that?
Who's going to buy it? Anyone? If I've got a litre of hydrogen to sell, has anyone got a hydrogen fuel device they'd like to buy it? We know the answer is no. So I'll give you an anecdote. So one that's working and one that didn't work. So the hydrogen one, we were developing a electrolysis-based hydrogen facility in Oklahoma, targeting the trucking fleet. And this was a few years ago. And at the time, there was some subsidies from the then US administration that made us think that we could sell that hydrogen on a energy content basis, so joule for joule, at the same price as diesel. But the feedback from the trucking companies was, well, hang on, we can get diesel trucks from all sorts of suppliers. We know that we can fill up with diesel at all sorts of service stations. So yes, it's fine that you're one supplier selling us hydrogen, but we need to buy hydrogen trucks, which are more expensive. maybe there's some reticence about is this going to work. So basically the demand just didn't emerge despite the subsidies. And so that one didn't go ahead. One that has been working and is going and is now in production is an ammonia facility, because ammonia does have a market. It's used for fertilizers. And we think if the European Union CBAM continues, it will, and some of the marine fuels regs they've got, it'll end up being a marine fuel and displacing marine diesel. And that's a hydrogen derivative. So you take the hydrogen, you add nitrogen molecules to it, and it's much more stable. So it doesn't have to be minus 100 and whatever it is that liquid hydrogen needs to be. So that's up in production now. So we started the ammonia phase, the lower carbon phase, which comes from CCS, because on this occasion, this is splitting natural gas through reforming and sequestering the CO2. We're hoping to get that going next year. And that'll capture about 95% of the CO2. And because there's a market for ammonia, we know we can sell the base product. To be seen, can we get a premium or the absence of a penalty in the CBAM to make that extra bit of getting into lower carbon, make that business case work? And that's the challenge. One last comment on it.
No.
The investors didn't like it. So we got punished by our investors for doing it, because they just said that is a low return business. Stick to your knitting. You're a good LNG company. We want the returns that come from that. So, and the ESG teams said it's great, well done. But actually the people that buy and sell the shares weren't big fans on the whole somewhere, but on the whole, it was not as positive as we'd hoped it would be.
It's interesting that you said that, because I had a conversation last week with another oil and gas company that was saying that actually some investors are asking them to stick to what they're good at, because if they want to buy renewable energy, they go to the pure players and not to the oil and gas companies. So, but what they're doing is actually doing investment under the radar. So they're in SPV vehicles maybe that we cannot assess, because if the information is not disclosed, we cannot assess that. But to your point about we're trying to gauge who's going to make the cut, they're getting ready for the tipping point, and they don't want to be wiped out. So there is probably a lot that goes on that we cannot assess based on publicly available disclosure, which is at the core of our design principles. So we only assess what companies disclose at the risk of greenwashing that you were mentioning earlier. But there is probably a lot going on that more that goes on that we might be led to believe, even by the media. And Kate, turning to you and perhaps even zooming out from the specificities of the oil and gas sector, why do you care about these transition plans, and what do you want to see in these transition plans to be investable in a way?
Okay, so I will continue slightly just to continue the conversation on oil and gas, and then I promise I will move on. So as you can probably tell, we in our climate transition fund do not invest in oil and gas, and potentially I'd be angry 24/7 if I did. But that's because of the point you made around credibility. And we know that the oil and gas companies that have been analysed in this review, their expertise is not in electrons, it's not in electricity. Their expertise is in the molecular energy, as you have just described. And the technology is just too nascent there. So CCUS, hydrogen, we're all very excited around this, but we're just not seeing it yet become scalable. So that's why we are investing in the utilities, as you mentioned, rather than in the oil and gas majors there. So on that point around credibility, we can see the ambition, but we need both. We both need both to marry. And that leads me on to the key point around this, which is technology readiness level. That's exactly what we're assessing. So you cannot pull the wool over our eyes. You can talk to us all you like about green hydrogen and CCUS, but if we haven't got the demand, as the room has just showed us, then that quite frankly is not a viable investment. So it does come back to financial returns as well. So one of our criteria is technology readiness level. Another one of our criteria is CapEx. So as we discussed there, that's what I got very angry about, because that for us is a key forward-looking indicator. So we can look at backward-looking data like revenue and see what products and services are driving revenue, and we can see those numbers today. But actually, if you want to be forward-looking about this, which we need to be for climate transition, we need to see where the funding is going. We'll also need to look at R&D. So we want to see, again, actual percentages there, but we want to see the initiatives behind it. And that leads to my third point, which is around decarbonisation initiatives and levers. So this is what I mean when I talk around sustainability reports, having a few handful of nice case studies. But what we need to see is that CapEx, technology readiness level, and then the decarbonisation levers all telling a consistent story. Exactly. So whether that's energy efficiency or fuel switching, we need to see all of these.
And actually on that, if you haven't looked at our State of Corporate Transition report that we published last year, we have a nice map that plots the climate solutions versus the technology readiness of the companies for which we have information, and it shows that sometimes it's not possible because the technology is not at a commercially viable state. But for example, for electric vehicles, the technology is there, and hence the solution is slightly easier.
There is another point that can be made on that around particular electric vehicles, is that what we also need is the conditions. So we need policy and societal demand. So for example, electric vehicles, it looks like we have all of these conditions. However, in somewhere like the US, we saw a lot of ambition. So we saw auto companies come out with targets like 50% sales will be from EVs by 2030. Ambitious. Yes, met our criteria for credibility, but actually taking a step back and look at the political and societal demand, that was unrealistic. So again, a lot of those names we've actually had to remove from our portfolio because they're simply not going to meet those targets. And I, again, can't hold those kind of names in my portfolio if I can't look my clients in the eye and tell them that what they're investing in is actually credible and achievable.
Great. Vanessa, perhaps this is a good point to talk about a little bit about the transition finance guidelines, because what I really liked about the new framework is that you have the principles that build on the TPT, on the transition plan task force guidelines, but then there is the assessment factors, but there is also the contextualization factors, which is something we've been debating at the center for quite a long time, because all our analysis for corporates is at the sector level, but now we're beginning to think about these external, well, first of all, the external dependencies driven by technology availability, but also the regional contextualization, that thinking about the jurisdictions in which these companies operate. So perhaps if you can speak a little bit
really quickly.
about how does that work, because I think it's, in terms of framing, it's really helpful for both investors and companies.
So if you want to look at it, it's you just Google transition finance. I
have it here. It looks like this.
Guidelines. And there's a handbook with case studies. So what we were trying to do, and we've just published an exposure draft. Let me go back to the issue. The way in which transition finance is working at the moment is that certainly in the UK and Europe, people are a little bit frightened of transition because they see increased greenwash risk. So they tend to skew to pure green plays. And when you're looking at transition, it's often financed at activity or project level rather than at entity level. So the council has developed these guidelines, which are looking at, if you want to call something transition finance, and for financial institutions, there may be various reasons why you want to do that. But if you want to do that, and you're applying it at company level, these are the things to think about, basically. And we look at, we've got 4 principles: credible ambition. I'm going to forget them now, aren't I?
I have them here.
Action into progress, transparent accountability, and addressing dependencies. And those are boiled down into they're grouped in factors, which is thematic just because it's an easy way of thinking about them. So targets, implementation actions, financial viability, governance, and engagement. And we have 15 core criteria that we ask to be met. So now on the sector and geography stuff, sectors and geographies are moving at different paces. So a sector in one geography can move very differently from a sector in another geography because the policy environment or the physical environment is just different. Your starting point is different. So within the definition of ambition, we allow for that variation, and we suggest using national or regional sector pathways or national or regional taxonomies, as long as they're science-based. And you can, of course, use the more global ones as well. And we provide for the concept of dependencies, because no one company can transition on its own. No sector can transition on its own. There are You know, the people upstream, people downstream, and there's a lot of policy and the need for incentives for new solutions. So the dependencies are what the company needs, what are the external stuff that the company needs in order for its transition to be effective. We also recognise that some of this will take longer, there'll be bumps in the road, you might have to recalibrate. So it's trying to be super practical about how you actually effect change at scale. We also have, and this is the bit that you were asking about, contextual factors, Carmen, which are other things that you might want to mash up into your transition finance analysis. So that could be resilience, it could be nature and biodiversity, it could be the extent to which you're relying on avoided emissions. And those we don't go into detail about because we didn't have time, but we allow for you to think about not just mitigation, but also some other stuff.
Yeah, that's very clear. And actually, one of the things that struck me in the report is that on the company side, it's not important to recognize those dependencies, but also what you do about it in terms of engaging with policymakers to make them aware about those policy dependencies and lobby or advocate in favor of certain changes.
And it's quite nuanced because you have to understand your dependencies, but you won't be able to solve all of them, but you should take reasonable action.
Yeah. Very good. Thank you. Modi, let me ask you one question to bring you back in. You've done with the team this enormous amount of work. If there was one thing that you could choose that would make your life easier in the next iteration of the assessments, what would it be? What would you like to see from companies' disclosure that you acknowledging that the comparison is difficult, as we've said, and because companies may choose different pathways, but what would you say? What's on your wish list?
I think a standard way of disclosing their transition plans is the key, because I actually conducted a small survey today with my colleagues to see what problems are we facing. And this is the common issue that we have, because companies disclose different things in their different reports, sometimes annual reports, sometimes sustainability reports, and sometimes through other platforms. And as I have shown in the report, we have shown in the report and I presented today, it's already intermittent and it's widely spread. So I think the one thing could be a sector-specific guidance or guideline or standard for disclosing and reporting the materials that's needed to assess the transition plans would be the very first and most important of this.
Great. Okay, so I started the panel asking you for some quick reactions to the report, but I would like some reactions now to the conclusions of the report. So Modir highlighted three key takeaways. Maybe we can bring them back on. So perhaps before opening the floor to questions, I'd like to ask you which of these, you don't have to pick one each, but which of these three resonates most with you? Starting for you. Sorry, Peter.
Well, in that case, I'll go for the first one. The optimism emissions and the methane versus for you find a business model change. And I'll come back to methane, but the reason I think this is so important is if we allow ourselves to simplify things to a degree that we just say, for example, all fossil fuels are the same and we just need to transition away from all of them as quick as we can with no differentiation, we leave an awful lot of emissions reduction on the table. So, for example, if you were God of the energy system for a day, I wish there was such a position and you had it, or goddess, or Tsar, whatever the word would be, and you had an extra megawatt hour of renewables tomorrow than you had today because you'd built some more. If you use that megawatt hour of renewables to replace a megawatt hour of coal-fired generation, you would save about a ton of CO2. If you used a megawatt hour to replace megawatt hour of gas-fired generation, you'd save about half a ton of CO2. Which one should you do for the best climate outcome? Clearly coal. Which one would you do if you were just following what's cheapest? You'd probably keep the coal and get rid of the gas, right? So when we say transition away from fossil fuels as if they're all the same, we're actually doing ourselves a disservice in the pace of a transition. We have to be willing, because we can see the pace of a transition is not going to be next year or the year after, but it's complete. It's going to be some time to come. We have to differentiate within those sectors. We have to recognize that gas-fired generation is better than coal-fired generation. But even within gas, to really get to your question, one of the great slides that Mudir had was at one that had the bar charts and all the dots on it, and you could see the biggest one and the biggest stretch out was on methane. Now, methane emissions super important. Methane around about 80 times as potent as a greenhouse gas as CO2 when you think of it over the next 20 years, which is the bit that really matters. So methane is super important, and yet the spread in the industry and across different countries and different companies is really large. And if we can find a way to get the lowest quartile methane efficiency up to the top quartile methane efficiency, we will be doing an enormous greenhouse gas emissions reduction. Not to say that top quartile doesn't have more to do as well, but that's the emphasis. I think if we can find a way to use models like the TPI to actually start to give guidance to investors on, okay, some of you won't want to be in oil and gas at all. That's fine if that's the product you're selling. For those of you that aren't and you're more economy wide and you are in oil and gas, here's the sorts of things that you should be starting to recognize that companies that are lower, better performance, lower intensity on methane are probably managing risk better in a whole number of ways. You might want to put your money in that direction.
So first, one comment: we don't give advice to investors. Just
of course.
That, but secondly,
advice, yeah.
But why don't companies do more about it? Because I still don't understand. You know, with satellite imagery now, it's so much easier to spot where these leaks are, and in many cases, it's just a question of turning off the tap.
Yeah, I'd say I think there's two different reasons. Firstly, there's just some parts of the world where the focus just isn't there. So so that seems to be something that we could address. And there's a thing called the Oil and Gas Decarbonisation Charter. It was set up at COP. I want to say COP28, but I might have got the numbers wrong. They come around quickly, which is all about bringing in nationally owned oil companies into the conversation to do technology sharing. So that's one thing. The other one, more fundamentally though, is oil is actually different to gas in this particular field. So if you're producing gas, and so you've discovered a gas reservoir and you're producing that, and that's what you're selling, you've got it in pipes and in tanks, and you're getting paid to sell it. That's your product. So you don't want to be leaking it because you're losing money. If you've got an oil development that sometimes has a very small amount of methane relative to the oil dissolved in it and it becomes free, you might have an oil pipeline, but you might not have a gas pipeline. And so those companies go, well, I've got no way of getting the gas to market. It's a bit of a nuisance to them. They're actually in it to sell the oil. They've got options. They can inject it back into the reservoir. That's an option. Or they vent it, which is terrible, or they can flare it, which is also not great, but at least it's going CO2 at less greenhouse warming potential than venting. So that's one of the things to figure out. The industry's signed up to zero routine flaring initiatives and oil and gas methane partnership. They're all transparency measures. You'll see those. But those underlying factors are really what underpins the variation in performance that you see.
Perhaps the investors can ask a little bit more questions about this area to put pressure. So, Kate, turning to you, what will be your pick?
I'm going to choose number 3. So CapEx allocation. So as mentioned, a key forward-looking indicator for the climate transition strategy that I run is CapEx allocation, because we need to see where you're going. Climate transition is fundamentally about the future. So that's a key piece of information that we need. However, to your point around there are other types of strategies, we do run money, which as I've said before, might just have a carbon target to be lower than a benchmark. It's not aiming for net zero. So for those type of strategies, again, capital allocation, we still need to see where you're going. But actually what's more important is not just looking at the data, but actually having a conversation with the company themselves to see, actually, can we understand your carbon trajectory in terms of operationally? So no, you don't need to be fundamentally transitioning your entire business to become net zero, but actually, where are the low-hanging fruit? And can we be confident that you're going to continue to reduce your emissions in the short term, so up until 2030, 2035, whatever we believe is viable in terms of our investment horizon. So where we don't have CapEx or data that we need to make those calls, what we need to do is we need to engage with the corporates as investors. And as I know, there are different types of investors who are asking different questions. So it's really challenging to be a company, I would imagine, in those conversations and give us consistent messages. But fundamentally, I'm looking to understand, is this investable? And as a fixed income investor in particular, what I'm most concerned about is stranded asset risk. So I'm concerned about, will I get my money back? So I'm not an equity who's looking for exponential returns. Fundamentally, I've given you a loan and I want that back.
So you focus on the downside.
So the focus is very much on the downside risk. So disclosure and conversations is fundamental to this.
And on that, since you brought to light the differences between equity and fixed income valuations, how important is it to you if you see capex going up, how this capex is being funded? Because if it affects your capex, if it's highly leveraged, for example, that's not a good fixed income story. Yeah.
That would also be a red flag for us.
Yes, exactly.
So fundamentally, we need to look at a company's balance sheet and see what they can actually afford to take on. So slightly to the point earlier around, if your expertise is in molecular energy and you tell us you're going to have a very sudden shift to electrons and electricity, however, you are highly leveraged and your balance sheet doesn't look like you can take it. Again, that's back to that point around credibility. It might be ambitious, but it's just not credible.
Thank you. Vanessa, over to you.
So I'm going to start by agreeing violently with Peter. The methane.
Violently, violently.
No, not angrily. Just that if we could do something around methane, that would be hugely impactful. Much more impactful on really than almost anything else we can do in the short term in relation to that sector. But I was going to talk a little bit about the low carbon solutions, because generally we have a challenge in unlocking low carbon solutions, because when you're starting to do something for early doors, it just takes a lot longer. It's more complicated. There's an elevated risk profile, and the return is generally not going to be as great, particularly if we compare with extractive sectors which are mature and which when the commodity price is going well, are doing really super well. So this is a general problem across transition, that generating, scaling climate solutions is just quite hard. And if I take you to carbon capture and storage, which is one of the things that has been hanging around longest without necessarily developing as quickly as one would, you know, not scaling rapidly. I first advised on that in 2005, you know, and it was a solution looking for a home, and it's taken a long time to get to a home, and the home will probably be smaller than anybody thought at the outset. We are looking here in the UK. We're just standing up a transition finance lab, which is looking at how do you sandbox some of the scalable climate solutions more generally, so that we can allow first of a kind projects to get through the process a little bit more quickly. And that is to allow a safe space for policymakers, companies, finance, and regulators to work out what are the challenges, whether the policy is currently in the right place. Are there regulatory hurdles that are just, you know, could be shrunk a little bit in terms of process and delay, and, you know, multiple agencies all having to give their views iteratively. So how do you take a viable, potentially viable solution to market, and then so that you allow the market basically to speed up its own process? And I think, and you see that going on in all sorts of places around the world, and I think we're going to have to do more of it.
Yeah, and to this point, we at the TPI Center, we've been part also of the work of the Transition Finance Council, and we published a finance playbook showing this iterative process and co-design almost between different stakeholders, and thinking about not bringing the investors as an afterthought, but from the very beginning, and really bringing to light the fact that there are different types of investors with different risk tolerance levels. So a project in a climate solution in its infancy might be for private equity investors, not for the asset owners has to be more conservative, but if there are structures that can be made as such so that the
There's
risk
a new
tolerance,
layer.
exactly, then it becomes easier also for other types of investors to come in. Modir, we said that the comparisons of transition plans are difficult because the plans are quite unique, but we've also provided a lot of benchmarking. If you were to give an advice to the companies, what lessons can they learn from these comparisons that we conduct?
Yeah, absolutely. I think as I summarized earlier in my presentation, the summary of all this can be the waterfall chart, because that's the essence of what we want to see from companies. When we assess companies, we see a lot of maybe titles or claims, let's say, of or plans that are not substantiated with actual targets and facts and figures and timelines. The advantage, I would say, or the design principle of the net zero strategies assessment frameworks is that we allow companies to have their own decarbonization strategy as they prefer. As an example, for example, if a company does not intend to rely on carbon offsets or other neutralization measures, we have mechanisms in the framework to still score them. Or, for example, if the company does not intend to diversify into low carbon alternatives, again, there is a way for them to score. So we don't want companies to score on all of the indicators in the framework for them to score well. So all that to say, I think the essence of what we think is good to see from companies is clear contribution of different decarbonization levers to their emissions reduction targets, clear timelines, transparent capital allocation, and that's, I think, what differentiates between claims and credible.
The reality. Great. I said at the start that there will be time for questions, so I want to open to the floor the possibility of asking questions. Great, I see some hands up already. Please, there are some mics coming your way. Please state your name and affiliation and make sure that you ask a question. And also there are some questions online. We'll take them. I'll take 3 questions here from the floor, and perhaps Ali, have we got any question online? Okay, then, okay, perfect. All right, great, thank you.
Hello, I'm Bree from Subsea 7 Group. So we're working in both.
Sorry, can you speak up?
Oh, sorry, can you hear me?
Yes.
Perfect.
Thank you.
Bree from Subsea 7 Group. So we service both the offshore renewables and the oil and gas sector. But my main question is maybe to you, Kate, is on your decarbonisation sort of lever space. You said that you're looking for companies to have clear quantitative indicators for decarbonisation. However, what is sort of your recommendation when things such as alternative fuels are at the mercy of market availability, and it's hard for us to put in a quantitative decarbonisation lever for that specific accelerator when we don't really know what's going to happen in the market?
Yeah.
Okay, wait, let's take 2 more and then we'll come back. Thank you. Thank you for the question. There is another question over there. Thank you. The mic is coming. Thank you.
Good evening. I'm Annette Peter. I'm a lawyer specializing in ESG and corporate governance. And I have a question on regulation. Might regulation actually help to bridge this dramatic gap between communicated ambition levels and actual ambition levels? For example, regulations on connectivity between non-financial information and financial information might actually be able to close this gap. And I would be very interested in your academic and practical views, whether more regulation would confuse matters, or would that actually help to reveal such CapEx gaps, for example.
Great, thank you. Thank you for the way. I saw another hand up. Yes, over there. Thank you.
Hi, thank you. I'm So Chan. I'm from CDP. And my questions are, first of all, sorry, my mind just went blank. Yeah. All right. First of all, just more TPI focused question. how does TPI maintain consistent reporting from companies? First of all, yeah, I don't know what the pricing is like. I don't know how it works specifically. If it is it increasing or decreasing? Just overall process. And second of all, you know, because these disclosure data that you have presented here, those ones are open access. And I just want to know your view, could be a personal view, organization view, what your thoughts on these underlying data, data underlying the data you presented, the underlying data are mainly through commercialized gates from LSEG or S&P, these kind of platform with pricings. So just want to know your view on this kind of disclosure process and how, the public interest as well.
Thank you. Thank you for the question. Let's start with the one for Kate, and then we move to the one for regulation, and then we can address the last one from CDP.
Thank you. It's a good question, and it's definitely a core challenge. So I think that's why I slightly tried to touch on the R&D spend as well, because I think that's where we can really understand the pilot projects and the technologies, the partnerships that they're making to get a really detailed view of where they think they may be going in the future. We can't tell the future. We know that companies can't either. My second point is that's why also engagement with management is so crucial. When I'm going through sustainability reports and you can see case studies on potential nascent technologies, it's really hard to understand actually the percentage of money that's going behind this, whether that's CapEx or R&D. So it's really crucial for us to get in front of management and actually have those conversations. So in my team, I have some incredible climate researchers, some incredible technology researchers. We obviously have the broader sort of credit analysts as well, who are very much up to speed about the technologies within their sector. So bringing those into the conversation, it's not just about sustainability, it's not just about ESG, it's actually what's credible and what levers can they pull, and having those conversations is very clear once you get in front of management if they are truly transitioning and are behind these, or if it's just they have a bit of extra capital to spend.
Great. And on the regulation, I think the question was, can regulation help with in advancing the discussion, particularly in linking financial with non-financial disclosure? I mean, we've had a lot of regulation on data disclosure, but not on transition specifically. Maybe you want to address this, Vanessa, and please feel free to chip in, Peter, if you have a view.
So on regulation, we've had a lot of regulation on disclosure. And actually, we've got a lot of sort of bog standard general regulation and law that can be and has been applied. I think there is a danger in thinking that regulation and enforcement action is always going to get you what you want and there will not be unintended consequences. We've gone through a big green hushing process because people have found that they were, and not always deliberately, quite often by accident, because life is messy, they got caught out on making green claims that were then enforced against by a range of different regulators who perhaps they weren't thinking about. So the Advertising Standards Agency has had a pop at a number of different financial institutions and corporates. And some of that is, you can sort of see how people got themselves into that challenge. So I think you have to be careful with it. For me, I think we have had enough toing and froing on regulation and would possibly just need to calm down, try and work through how to disclose when the process isn't linear. Obviously, if there is a say-do gap, that's a problem, but we do actually already have the tools to deal with that.
And we've seen what happened in the EU. You're talking about the UK primarily, but we've seen what happened in the EU. Would you like to add anything to this point?
Just a couple of quick ones. I wish I'd had the Transition Plan Task Force guidance document when I did my first climate transition plan 3 years ago. because in the absence of it, we had TCFD and then just going and asking people what they wanted us to put in. And we ended up with a laundry list that was very long. And
Change it.
well, yes, thank you for suggesting that, Carmen. But I think that when I look at it now, and sometimes I go back and read it and I go, wow, you can't see the wood for the trees. There's so much in it. But so we've now in Australia, we've got mandatory climate-related disclosure legislation based on the ISSB framework. It's AASB, Australian Accounting Standards Board, S2, and Laura, my colleagues over here, did our first report. I think that's helped to some degree. It helps you. Otherwise, am I going to do climate action? Am I going to do CDP? Am I going to do GRI? Like, you know, World Benchmark. Everyone's got these different things they want, and we're just going to go, we'll do this one. But I think in the first phase, it means that everyone will converge probably on the level which is compliance, and then maybe it will start to build back up again. But so I'm not sure if it helps. I've got some comments on other forms of regulation, but maybe that was off topic, so I'll come back to it if you want.
Kate, do you want to comment or no? Okay, I just want to say it's a bit the chicken and the egg, because what we're doing now is trying to ascertain what good looks like based on the transition plans that are being published. So you probably have the first mover disadvantage, but we're learning by doing. I'm turning to the question from CDP. Sorry, I forgot your name. I can partly address it and then I'll turn it to Wodir as well. So first of all, to clarify, as I said earlier, everything that we do is based on publicly available disclosure that companies, banks, or sovereigns, for that matter, publish. And all our data are available on the website. They're free to use unless they're for commercial purposes. The relationship with LSEG and FTSE Russell is that they use the carbon performance and the management quality scores to build TPI Climate Index series. And also they helped us to do the management quality assessments, because we do 2,000 companies, as I said. You arrived a bit earlier, later than when I mentioned this at the beginning, but we assess on carbon performance 580 companies on 13 hard to abate sectors on 2,000 on management quality. I'm not sure I understood the question related to pricing. Was it the pricing of our data, or the pricing, how markets are pricing the companies that we assess? Yeah, well, they don't disclose just to us. As I said, they disclose, actually all that we built was based on existing reporting frameworks, because we didn't want to add to the reporting burden of companies. So back in the day when TPI started, it was the TCFD and CDP, the questionnaire of CDP. So that was the idea, and we do the same also for banks and for sovereigns. So I don't know if that addressed the question. Would you like to add anything else in particular? Okay. All right. We can take this offline if you want to know more about it, with pleasure. I think would like to take one or two questions if we have online, and then perhaps if there is time, we can still have one or two here on the floor, if there is any. Ali, please.
Yeah, maybe I'll give you two that I think are
that'd be great.
most relevant. So first one is, how do we address the segregation of investors within companies? It sounds like ESG and standard investors have separate goals or visions. How do you think we can change this? And second question is, what role can taxonomies play in defining and enforcing credible transition plans? And are existing taxonomies fit for purpose?
Yeah, okay, so the last question was perhaps close to the other one on regulations, but could we comment a little bit maybe on taxonomies and interoperability, if possible, and then we turn to the first question. Who wants to take this?
I'll do
Yeah,
taxonomies
that's
if
great,
you want.
thank you.
So taxonomies can be useful, but they are, they are a lot of work in relation to specific defined activities. And so it's a finite universe. They're super useful in relation to the CAPEX, or at least the EU one is. And we have a bunch of taxonomies, particularly out of Asia, that are transition focused, and some that are really quite good in terms of giving you a trajectory. So useful, not the only thing on the block. I think the use of sector pathways is also really, really important and is starting to ramp up. And if you look at some of the countries that are very focused on transition, particularly some of the Asian markets, they're using both. And that tells you pros and cons with each.
Yeah, and we internally been debating and actually also published recently a blog about this. but what you define as climate solutions and as climate enabler, not just solutions, and what are the boundaries that taxonomy set, and the fact that there are multiple of them, and depending on the jurisdiction, you have different definitions that perhaps would benefit from more uniformity. Peter, would you like to address the first question, maybe?
Yeah, sure. Yeah. Although I would also agree on the taxonomies, if I could just very quickly, although I think, like with regulation, the challenge is if you try to do one which is simple and economy-wide, it gets really hard to then get it right, which is why sector-specific buffers are really helpful. So I think we just need to be very careful that we don't have an inadvertent chilling effect on parts of the economy which actually are making a positive contribution, maybe not as much in line with a particular standard, but still good. So that's on taxonomy. On the investors, you sound, I don't know who asked the question, it sounds a bit like me kicking the cat when I get home sometimes, like, because that's one of the frustrations is we do hear different things. But I think when I pull it back, I go, actually, I don't know that it is a problem, because fixed income does have a different perspective to equity, right? So fixed income are looking for, they know how much they're getting paid, they just want to understand what's the risk of it going wrong. I'll probably simplify what you do there, sorry. Whereas equity are looking for, how do they maximize the return? And it's not illegitimate. It's like, sometimes that sounds like it's a grubby thing. This is what's paying for our retirement incomes, right? So it's all of us that are benefiting from those things. So I think having one that are tailored is very good. Probably the thing that might be helpful is, and it will start to come in, is as actually the financial sector has to do its own mandatory sustainability reporting and explain what they're doing, and feel the pain that we have in the corporate sector. I actually think that will start to then bring to light, if there are differences, are those differences actually reflecting underlying legitimate differences, or are they just differences in approach for no good reason?
We get to that point, but for now we're focused on the target alignment in that sector. Kate, would you like to add?
I'd just like to build on that a little bit further, because there are so many nuances between different types of investors. So yes, there's a fixed income and the equity difference, but even within the strategies that I support, there's a difference. So that's where the concept of double materiality really comes in. So fundamentally, for every single fund that says it integrates ESG, what we're thinking about there is financial materiality. So we're thinking these ESG risks that you have, whether it's stranded assets, whether it's slow transition, what is the impact of that to the company's balance sheet? And then for fixed income investors, it's what is the impact of that to their credit rating? Are we going to see downgrade? Are we going to see default? Because fundamentally, they are not managing their risk. That's not even anything to do with ESG. That's just basic fixed income risk management. However, as I keep alluding to, we also have a whole spectrum of funds that go a little bit further than just ESG integration, and they also look at impact materiality. So that's exactly where that climate fund comes in. And what we're looking at there is not just the financial materiality, because fundamentally I do want to make a return for my investors, but also what is the positive impact that that company is having. And again, that's where we need all these pieces of information that I've been discussing on this panel to make the right call there, to ensure that I'm not greenwashing my investors. So, and my end clients, essentially, which could be a pension fund that anybody here is already invested in. So there's a lot of nuances to that question. I think it's a great question, and I think it's a huge challenge for companies, but it's also a huge challenge for even an asset management firm that run a variety of spectrums. That we need to make sure that internally, when we're going external, we're actually all aligned, and we're all asking companies to do the same thing to, one, ensure that we get a financial return, but two, we also meet our sustainability and impact goals where we have them.
Great. I think I was overly optimistic. Maybe we won't have time for further questions, but we can take anything else offline. First of all, thank you for the very frank discussion. I always say that the data that we produce are only as good as they're used, and today's discussion is precisely to encourage conversations about how they are being used. And so I'm really glad that you've accepted the invitation and you've been so candid about the sharing your experience. Definitely, the transition is not easy, but the more you dig deeper, the more the nuances that you have to assess. but use our data and first of all, read the report, of course, but use the assessments that we make to have those conversations. We haven't talked a lot about engagement and the type of engagement around transition plans today, but first and foremost, we want to encourage the transformation of businesses and not necessarily to divest unless it's a last resort or is really necessary because of lack of evidence of progress. So do speak to companies, do speak to policymakers as well, and keep coming to our events. Thank you for joining. Thank you for joining.